As we head into 2026, many investors are asking a familiar question. Are we setting up for another dot-com bubble burst like 2000, or is the AI trend different? There are three reasons we think a true AI bubble burst is unlikely. First, today's tech market looks quite different than 1999. Valuations are actually lower, and fundamentals such as profit margins and return on assets are much stronger. Second, a key trigger for 2000 wasn't valuation alone. It was a recession that contributed to collapsing earnings. So if earnings stay resilient, the bull market may continue into 2026. Third, recession risk looks contained. Capacity utilization is steady and well below historical overheating zones, consistent with a soft landing. Bottom line for investors, AI is being powered by stronger fundamentals than prior cycles, and unless earnings falter, the bull market will likely keep moving forward. And with that in mind, let's turn to equity perspectives and what the market may be signaling for 2026.
If we zoom in on stocks, 2025 will likely close out with strong equity returns for a third consecutive year. The S&P 500 rose over 17% through November, but consumer and investor sentiment has remained surprisingly low during most of this year's rally. While investors may be feeling a bit of the holiday blues, we think the ingredients for equities to continue advancing in 2026 are in place. Real GDP has been trending higher, the earnings outlook remains strong, and the Fed appears to be poised to deliver more rate cuts. This year's rally hasn't just been about a handful of big tech names. Small caps, international stocks, and sectors like healthcare have been joining in. Dividend growth strategies outperformed in November after trailing the market for much of the year, and we think this trend can continue. So what does it all mean for investors? First, consider a covered call strategy powered by daily options to target high income and capture further potential equity upside. Second, look to dividend growth stocks, especially in the mid and small cap segments, to add quality to your portfolio. And lastly, diversify tech-heavy large cap exposure using X-sector strategies to help manage portfolio risk. Now, let's turn to fixed income to explore what the rate environment and inflation imply for 2026.
2025 was a strong year for bonds, showing that a high starting yield at the beginning of the year can lead to healthy bond returns. Fixed income ETF flows are above their recent averages as stock-bond diversification improved, and the U.S. Treasuries held their safe haven footing even through the April tariff shock. Looking ahead, the labor market slowdown is likely the near-term focus. Wage growth has cooled while the unemployment rate is drifting higher, suggesting a demand slowdown supporting further rate cuts. At the same time, inflation remains a tail risk for long-duration bonds. The steepness of the yield curve reflects the market's concerns around inflation uncertainty and fiscal deficits. Finally, AI could influence the bond market in two ways. Heavy investments may add to inflation pressures in the near term, but over time, productivity gains could help bring down inflation. For bond investors, we still see a place for short to intermediate term bonds in a well-diversified portfolio in 2026.